So, Professor, I asked Roger Ferguson, former Fed vice chair, is Jay Powell really in charge, or is the 10-year in charge? And what I meant by that was, isn't it good that there is a governor, a real-world market governor on the Fed? Because if the 10-year telegraphs you've done enough, the Fed's going to have to listen, or then they're just really stubborn. Do you think that's a positive?
Yeah, you have to listen to the 10-year. Listen, Joe. In less than in about 15 minutes, we're going to get some important housing data, the Case-Shiller data, the Federal Housing Loan Agency data on housing prices. I expect them to show an actual decrease in home prices, something that the Fed can't ignore, even though their lagged way of computing it. Now, they're going to get the CPI, it's often been mentioned, the day before the FOMC decision, and the CPI on housing is going to show a positive increase. So the 10-year looks at the real world, and they don't see the prices increasing. They see the prices decreasing. We're not even talking about a slowdown in housing inflation. We're actually talking about negative housing inflation, and we'll see. But I bet in 10 minutes we're going to get negative numbers there. This would be the third month, and they look at on-the-ground price indexes, and the Fed ultimately can't ignore, despite what they say and despite what they quote, those on-the-ground price indexes.
The Fed, I mean, are we all in on the sort of the game? Talk, they can talk, can't they? And that can lower inflationary expectations. They can do a lot of talking about where they're going to go and what the terminal rate is, and that's cheap. It doesn't cost them anything. It doesn't mean that they actually follow through on it. Is that part of what they're doing here? And will they look and listen to market conditions in terms of not stock market? It looks like they like it when the market goes down for the wealth effect if they're trying to hurt demand. But they would have to ignore the bond market at their own peril, and they could go too far. The bond market could be saying, stop, and they could go too far and just bring on their own hard landing that wasn't necessary.
Yeah, absolutely. The Fed is really very data dependent. I mean, I've mentioned before, they kind of laugh when they say all through next year, we're going to, keep the rate tight all the way through the end of 2023. Well, take a look at their past predictions of what they were going to do. A year ago, they were not going to raise the Fed funds rate more than 25 basis points this year. Well, what did they do? I do expect a 50 basis points because I think the price data is going to look good in the December meeting. I really hope that they really just pause after that and let the tightness that they've already induced and the decline in the money supply. By the way, we got it last Tuesday, the 7th consecutive month of decline in the money supply, the biggest 7-month decline since World War II. I mean, this is a very restrictive policy that if they try to keep this restriction going through next year, a recession is virtually 100%. But I think they're going to pivot once they see the weakness in the data come through.